Joining me now is Abe Deshpande. He's Centerstone Investors founder and chief investment officer. Abe, it's great to see you again. And before I ask you about the meme stocks, broadly speaking on the NASDAQ, which Paul Tudor Jones was saying today still has a PE north of 35, do you think that is likely to remain under pressure until that PE comes back down into the 20s?
Yeah, I mean, I can sort of see both sides of this. Probably the most relevant one for me anyway is that multiples expanded while growth rates were expanding during COVID. And so what's the flip side of that is growth rates, they're not going to shrink, but are they going to slow the growth? What happens to multiples in that case? And I think that multiples should contract. So in that sense, it's hard to argue that.
So explain what you're talking about, the GDP growth slowing?
No, for instance, Microsoft was trading at 20 times, 25 times, maybe at the most earnings before COVID, while it was growing 10 to 15% a year. Last year, they're growing, and even last quarter, 20 to 25%. The multiples at 40 times earnings. Mm-hmm. So if growth rates go back down to pre-COVID growth rates, what happens with multiple? I don't know who the natural buyer is for a stock that is highly valued, but the growth rate is coming down. That's not us. It's not most growth people. So I'm not sure who that natural buyer is, and that can create some uncomfortable moments maybe if what I'm saying happens, like if growth rates actually start to tail down.
I like the way you're coming at this because most people have been trying to separate high PE from low PE, or highly profitable versus not profitable or barely profitable, and you're really just looking at growth rates and trends.
In this universe of high multiple stocks, it's really like momentum stocks. It's driven by earnings momentum, and that you sort of compound it. Earnings grow very fast, and then you put a higher and higher multiple on that. That eventually reverses. At some point, it's happened many, many times. I don't know when that's going to be. Maybe it's now, maybe it's 10 years from now, for all I know. But that's something to be worried about, especially now, because now clearly you're going to be starting to compare against, it's going to be very difficult comparisons this year.
So not to put you on the spot on a particular stock, but Alphabet was a big point of debate last hour. This is a company that returned over 60% last year and had accelerating growth throughout the pandemic. Should they and other pandemic winners expect to see slowing growth and poor returns this year?
Yeah, I mean, Google or Alphabet, things like that, they have a lot of tailwinds that are sort of divorced from the COVID recovery kind of idea, right? They have increasing market share of advertising and things like that kind of feed into it. But on the flip side, there are many other sort of meme companies that don't have the tailwinds. Those types of tailwinds, they benefited from people bringing technology spending forward into 2021 and early this year. Those are the types of companies that are going to have a difficult comparison. Teladoc is a really good example of that. They'll tell you in their own investor presentation they're going to grow 25% for the next 4 years, but they tell you they're going to do that by their customer account only growing 3% a year. It's all cross-selling. So there's some sense that already some of these very popular meme stocks have already reached kind of a maturation point.
Right.
That calls into question the multiples, and those are the types of companies that probably should have or could have more difficulty this year.
And a final question is, we've outlined where you see a lot of risks. Where would you be putting your money then, or where are you putting your money?
We continue to find Ben Graham said, and I'm not even that old, but I feel old quoting Ben Graham, right? But he said, the market is on the one hand, sometimes a voting machine, sometimes a weighing machine. Voting machine means whatever stock is the most popular has the highest, price. We're going to where the voting machine is telling us that intrinsic value is well separated from the price. The market, it's the purpose of the market is to weigh these intrinsic values versus the prices, and the design of it is such that prices will fluctuate greatly from the intrinsic value. So we're going international, we're going small mid caps, some industrial names, things that would be broadly characterized as recovery areas, and we're shying away from really these high growth names.
International, industrial, small mid caps, recovery plays. That's where you're looking to put your money. Abe, thanks for joining us today.